Welcome back to We Hate Money, episode 10, and a long time between drinks. 6 months is our last episode, so welcome back, Wiz. How you going, mate?
It's been 6 months. I can't believe it. Doing well. You?
Yeah, I'm doing all right. I've had my ups and downs, which has probably contributed to why we haven't recorded, so I apologize to you and our few but loyal listeners.
Well, we shouldn't disappoint them with our fantastic commentary, so let's jump right into it.
This one goes out to Roberto, Bromide, and 50. I think those are the only two that asked for an episode, but maybe we'll endeavor to get a few more. Yeah, so what are we going to talk about today, mate? I've sort of said to you off air that I've been poking my head in here and there, but I haven't been keeping up with financial news as much as I normally do because I've had a lot going on. Um, had a lot going on from a family perspective. So yeah, what's been happening?
Well, earlier in the year, I think around March, just before then, we talked about how, you know, everything seemed to be pricing in too much good news. Well, apparently that wasn't true because it priced in even more since then. So we made a new all-time high at the 4th of July,
Yeah, yeah.
way to go, America.
Let's go.
Um, but yeah, here we are. Now we're in September,
Well,
if you believe.
if you think about
Oh,
6 months ago, which was our last potty, it was S&P was roughly around 5,100 ish. And
yeah,
like you said, it hit the all-time high, which I don't know exactly what it got to. What was it? 560, six
three
hundred,
and
six
some,
hundred.
yeah, and some change.
And then
So
we had that weird like Black Monday in August where it dipped down, but now we're back. I mean, we've had another small dip actually the last week or so as we entered September, but man, August was like a full recovery month, wasn't it?
it was, some people called it like a de-risking, a de-leveraging kind of thing. Other people called it an event that's not over. Um, I mean, maybe it was a correction long overdue, uh, maybe a harsher correction, but I mean, we've rallied for almost the entire year, except, one or two to 3% down weeks, and that's it. So maybe, maybe this is it, Arnie. Maybe next stop is the moon. We'll see. But it's been interesting how
Yeah.
inconclusive everything is.
What's your gut feel? Like, do you think we're going higher, or do you think we're in like due for this correction that people have been calling for like since COVID, basically?
You know, to me, at the end of the day, it's going to come down to whether or not we're seeing earnings actually materializing for sort of the pricing in we've done
Mm.
on the S&P. And most of the S&P is still elevated by only a handful of names. So, can we depend on Microsoft and NVDA and Apple and Meta to continue to bring the economy forward? It's a good question people need to ask themselves because we have a lot of people selling. We've got some of the billionaires selling. You've got Warren, who's been rotating out of Apple into T-bills.
Yeah,
That's kind of auspicious.
he's a good
Um,
indicator. He normally does, well, not just him, but Berkshire normally does sell the top. So them leaving Apple in size is a big indicator. Yeah, I wouldn't say it's like definitive, but it's a big indicator.
it's a good sentiment check, I would say. Maybe it's good to put on the brakes a little bit. Just take in where you're sitting.
Mm.
Um, I don't. That's never a bad thing. Some retrospective when it comes to what you're owning and buying. But I mean, if you believe people who say that the economy is doing great and the soft landing is here, you can look at a million data points that'll tell you that's true. If you don't believe that and you believe the data that says the economy is still slowing down, inflation's still a problem, then it's sort of a duality of viewpoints.
Yeah, I don't know
What do you,
I don't know
yeah.
where I land on this. Like, I think like I still think inflation is a problem. I think it's going to. It's like you said, can earnings carry us through basically? But it's also like the cost of living pressure on everyone, Americans, Australians, just the world in general, is still elevated. So it's like, how long can they keep that up without like real wages catching up? So I think that's also part of the problem. And then you've got this phenomenon of the wage price spiral. Like obviously they want like central banks want to avoid that, but if they don't, because people need pay rises to keep living. Like how I don't know how we're going to get out of this. So I guess it does depend on the next couple of quarters from an American perspective, like how your economy grows or whether it stagnates. Yeah, I don't know.
Yeah, and it's just I think that we're gonna see it. I think we're gonna see something happen by quarter 1 of next year. I don't think we can continue to to be indeterminate for that long.
What sort of
It's just
thing? Like what sort of thing do you think is going to happen?
well, I think either we're gonna have um, data that confirms and solidifies one narrative or the other that we're seeing right now. So either we've done it, we've guided the economy onto a sustainable growth path again, and it's time to cut interest rates, or the economy has just been living off of credit and leverage for the past who knows how many months or maybe a year, and it's run out of that. It just kind of depends
Well,
on
so
what the problem is.
do you expect the Fed to cut rates?
I think that they're going to have to cut rates at some point, but they seem pressed to do it sooner rather than later. So
I don't know,
I
man.
think,
Like, I think the
yeah,
right move is to not cut. Like, if they can hold at this level and people can sustain this environment we're living in, I think that's probably the best option. Like, if they cut, it will send stocks to the moon probably, but it'll also potentially cause inflation to rage, depending on how much they cut by.
it's the duality of the risk, right? That we can take from that. So is cutting the right? I don't know if cutting is the right thing to do because employment isn't weak enough yet. It's getting weaker, but is it weak enough for the Fed to start cutting? And how much do they cut? So I think if they get a really scary unemployment report, that could push them to cut aggressively. And that's where I think we'll start to have a better view. But if
Oh, well,
employment is stable, then maybe they don't cut. Maybe they do a 25 basis points just to say we cut,
let me ask you
and
this then, Wiz.
then they hold off for another year.
So give me gut feel for the September meeting, gut feel over the next 6 months, what you think they'll do, and then give me gut feel what you think will occur over the next 2 years, 2 to 2.5 years, in
Oof.
terms of. I know it's just a prediction, and you probably won't be right either way. But like, yeah, what do you think is going to happen in the short term, the medium term, and then the I don't know, medium to long term?
I think the odds of a 25 basis point cut is likely in this upcoming meeting, unless something happens, right? But I could see them also pausing. I lean towards a cut right now. Um, and I can see a more drastic cut in the future. I just don't believe that unemployment's going to sort of rise a little bit and then peter off and go sideways. Usually that doesn't happen. So it's going to depend on how firm they can stick to the policy. 2, 3 years out, um, I think we could have a recession that lasts 1 or 2 years, and then we could be right back on it. So
So, but
maybe
if it's a
within one,
recession, do you think they'll also cut into a recession just to like ease the costs on everyone?
I think they'll feel they have to.
Hmm.
Is if that's the right thing to do, it's going to depend on how commodities behave and how the market responds to those cuts.
Because what I'm thinking,
Because
like,
oh yeah, yeah,
where my mind goes with this is like, if we know, we don't know, but there's a high likelihood that this September meeting they're going to do it, probably a 25 basis point cut, right? And if all goes well and everything's stable and that doesn't break anything, they'll probably do another one at the next meeting. And I'm thinking like within 6 months' time, they might have done two or three 25 basis point cuts. And then over like 2 years, if a recession actually occurs, they are going to have to cut into that. Like they'll probably cut, I don't know, they'll cut it by half what it is now within 3 years' time, basically. That's what I'm sort of envisioning. And if that's the
Yeah.
case, the play here is something like TLT leaps. You know what I mean? Like so, like if they're going to cut rates, price of bonds is going to skyrocket
Well,
over
maybe,
that period of time.
yeah, maybe TLT leaps because you could have a rush to safety, right? But I think we have to remember the conditions we're still in, that the Fed doesn't really control long-term rates that well. And the TLT is comprised of longer-term rates. So, you know, don't get too, out of the money on that. But I don't know where to me the problem is that the debt for the United States is still extremely high and it's unsustainable. And
And
the
there's
Fed
no
has
good
said so.
solution, is there? Like, there's no like what? There's no good
Right now,
solution for how to fix that. Yeah.
yeah, well, there is a good solution. It's called stop borrowing. Um,
It's like, have you seen that tweet? There's like a famous tweet. There's a famous tweet from a while ago by this guy called Wint or at Drill, DRIL. And he says something like, I need people to help me with my budget. And he's got like weekly budget, like food, 250, like petrol, $50 or whatever, candles, $3,000, family, like pet food, $50. And then the first reply is stop spending so much money on candles. And he replies, no. That's the US government, bro. Stop borrowing so much money, and they're just like, no.
no, no, we're just gonna see their solution is to raise taxes, right? Which is ironic because we're at a sort of a flexing point, right, in the data, and raising taxes could pull the rug on the economy.
It really depends on your train of thought here. It's like in a nutshell, the very simplistic view on this is like if you cut taxes or you cut the tax rate, then you're going to stimulate the economy because more businesses are going to want to do business in America and they're going to innovate and they're going to employ more people and they're going to pay more people and that sort of flows
Well, I
through
don't,
to the various, taxes and things like
yeah,
that at the federal and state level. But the opposite
I
side of the
wouldn't say,
coin is
yeah,
the
I wouldn't
opposite
say
side.
cut taxes. Yeah, I would say just don't touch them. Just leave them alone.
Yeah, I'm
Yeah.
just sort of stepping out. Like, yeah, you could leave
Oh,
it
yeah,
alone,
yeah,
but
yeah,
the rationale for cutting or is that basically it's like if you cut tax rates, it's going to stimulate the economy and just have more growth. And then the opposite side of that coin is like okay, but we've been borrowing for too long and basically paying with money we don't have, so we need to recoup it. So you need to raise the taxes in certain areas to try and recoup that. But then the problem becomes is that most American entities, I don't know the numbers, but most of them would have their uh, tax planning structured in such a way where that money isn't being returned until there's like a tax holiday and they can get it in like at a very much discounted rate or or tax free somehow. So
yeah.
it's like a double-edged sword. Oh, not even a double-edged sword actually. It's like a catch-22, I should say. It's like I think the lesser of the two evils is just cut rates, and even though in theory you're not bringing in nominally as much tax, the scale might scale up, and you might bring in more tax just by pure scale.
Well, and
Yeah,
inflation's already raised taxes in itself, right? Because
yeah, of
incomes have
course.
gone up. So it's like, do we
Revenues
really
have gone up. Yep.
property values have gone up. I mean, everything they tax has gone up
That's
and
why
it's passively. So
I mean, you and I were
t
talking about this like, years ago now. It would have been years ago when you and I were saying like
yeah.
the play for inflation was find, like undervalued companies that have modest to medium debt at whatever rate they've fixed it at or had it sort of set at. And I remember I was talking about Ford a lot at the time because I think they fit that bill where they're like, in a relatively good spot with a fair chunk of debt in their automotive business. I'm not talking about their credit business. But it's
Mhm.
like, them having that, we sort of saw, I don't know if the actual economics have played out for Ford because they've had a bit of a tough trot. But if their revenues have gone up because of inflation, and they've managed to keep their costs in check, then that debt's going to become easier to repay. And that's what we're seeing with a lot of companies, right? Like they're just getting way more revenues. Their costs or their efficiencies are working as intended. So they're able to use that leverage and pay that debt off easier and quicker.
Yeah, and you know, that's not the case for every company, right? So you got to
No,
do
it's
your
not.
due diligence out there. But I would say it's good to see companies adapting to the environment that we're in with inflation. But, we still have to remember that unionized companies, they are going to want to increase their wages more to capture more inflation in the future
Ford, another
because
good
that,
example.
yeah, which the government does that passively for its own employees to keep that in mind. And the US government is the largest employer in the United States. So when you think about it, the reason why we continue to see wages go up is because a lot of a lot of employment already has that factored in for those adjustments. So is the data skewed? I don't know. I'm sure you could dig it out and figure out who's actually suffering and who's doing okay. But I mean, things cost a lot more than they ever have, at least within living memory. So it's starting
Yeah.
to get people very uncomfortable. At least what I've seen, people are very concerned about where costs can go from here. So,
Mm.
and that's a natural thing, but that has nothing to do with the economy, though, Arnie, because the economy, jobs are fine. Yellen's right. There's no red lights flashing.
Well,
The
it does have something
soft
to do with the
landing is
economy.
here. Well,
It does. It does have something to do
well,
with the economy, but it's just one piece of the puzzle. I think
well,
you're trying to say.
yeah, it's there's a separation in the economy between different employers and classes when we start looking at it, and everyone's sort of affected differently because of that.
Yeah.
And that's so you can have people say, oh, employment's strong, but we're also seeing good jobs starting to wind down. So is it really that strong? I don't know. I mean, that's why I'm saying the
Mm.
data is not really conclusive yet.
Yeah, that's fair.
But so
Yeah.
I don't know. I'm kind of
Um,
talking in circles there. But
no, it's good.
Hershey's,
Oh,
Hershey's.
wait. Before you talk about Hershey's,
Oh,
I wanted to say,
yeah.
that's a good macro chat. But I think, like I said to you off air, that I wanted to catch up on all the stocks we'd talked about in the last couple of episodes, which was 6 months ago, and just do a little sense check to see how we were going on the positions we had been playing or had long-term holdings in. So yeah, go
Uh,
ahead. What's Hershey's been doing?
Hershey's has just been consolidating over the last year. It had a peak and then it pulled back considerably. And I think I would start to become bullish Hershey's pretty soon. They have they have an element of pricing power when it comes to what they do. So
Hmm.
maybe Hershey's is going to set up to go to a new all-time high. But I think watching Hershey's in the next 3 to 6 months might be a good idea
I know
to
that
see.
Hershey's also controls their own supply chain, which is a huge boon for these particular times we're living in. We're not their whole
Yes,
supply chain, but I know that you and I looked into like where they get their cocoa from, and it's basically vertically integrated.
yeah,
Um,
and it's relative value area, right? And I say that with air quotes because it's sort of consolidating below its 2022 levels. So um, I would just keep my eye on that. But we saw as inflation went up with cocoa that Hershey's did quite well. I think it was when sugar peaked that they stopped doing well.
so maybe that, yeah, but because sugar, the way they get their sugar is from sugar beets, yeah. I think from memory,
Well,
you and I looked into this. Was it sugar beets? How they get their sugar?
I think so, but I mean, there was like a sugar beet issue because of weather for everybody. So if you wonder why sugar no longer costs 99 cents a pound, well, there's your answer. Um, So I think most people get, at least in the United States and Europe, get it from sugar beets because I think Russia, the United States, and parts of Southeast Asia all use sugar beets to make
Hmm.
most of their sugar. Unless you live sort of in the Caribbean areas, then you would get some sugar cane from that.
All right,
But
Wiz. I've
oh yeah,
I have brought up the stocks that we
right.
discussed 6 months ago. I'm going to quickly read out the title and then I'll go through what they were 6 months ago, where they've sort of been, and we can do a quick brief commentary on what we think is going on and what's going to occur. So the stocks are that we discussed on the last couple of episodes: Tesla, NVIDIA, ARM, DWAC, which became Donald J. Trump Media or whatever it's called,
Mhm.
Netflix, SOFI, and Playboy. So let's start with Tesla. 6 months ago, Tesla was trading at 177 USD, and then it went down to about 162 shortly after that. It got to a high on the 10th of July of 263, and now it's back to 216. So fair bit going on with Tesla over the last 6 months. You got any thoughts on this particular stock?
I think right now it's a wait and see kind of event. Just and I say that because there's a lot that is being promised, and I think people are pricing in from that earnings up till now, those promises sort of materializing maybe a little bit sooner because of we know Elon's timelines can be a bit optimistic. Um, uh, but I think that it's just going to meander around within the 200 range, give or take about two or three, about 20 to 30% up or down.
Yeah, I
It's
don't
just going
know.
to, yeah, I just don't see it going to the upside until we start to see things actually become finished and start getting ramped up for production.
There's a few big catalysts on the horizon for Tesla. When they occur is always, yeah, up in the air, and there's no concrete date. I know the two big ones, or like one very, very big one, which could potentially be huge for Tesla, is that they're applying for approval from the Chinese government and certain parts of Europe, so European governments, to trial their full self-driving, unassisted, or well, I don't know what to call it. Like, like at the moment, like full self-driving, you have to be there, present, hands on the wheel. Um, then whatever they're calling this is, it's going to be like unassisted. Like you don't have to have your hands on the wheel. There's no steering wheel nag. They want to trial that in China and parts of Europe in the first quarter of next year. So they're seeking regulatory approval. That could be big for the stock. But yeah, in general, apart from that and a few other catalysts, I agree with you. I feel like it will meander until a positive or a negative catalyst sort of sets it off. Do I think it's fairly valued? Nah, it's probably still overvalued just based on the energy and automotive business, but it's these prospects for growth that could send it up even higher. Um, so
I, I
would I buy Tesla right now? Probably not, but I'll still hold what I got.
yeah, I wouldn't say short it or long it with any leverage. If you're curious, sure. I mean, why not? Dollar average in
Hmm.
if you're optimistic, because you can always just exit once you get to a certain level that you
Yeah,
feel
true.
uncomfortable with.
Stop loss it. All
But
right. I'm on a burn
anyways,
through
on yeah,
Nvidia.
let's go.
This is the big boy. Nvidia. What do you So Nvidia was trading 6 months. This is after. So it's had a split since then, but it was trading at $85, 77 USD 6 months ago. It got to a high on Tuesday, 18th of June of $135.58, and now it's trading at 106.47. So Nvidia has been through a wild ride since you and I spoke.
It has, and to me, NVIDIA is probably cooked. Um, I don't see its earnings being able to continue to justify its premium right now.
Hmm.
It could always, of course, turn that around. That's always possible, but it's the law of large numbers. There's only so much money that exists in anybody's industry, and NVIDIA has had a tight control on that. But it seems like they've reached the top of that. I think the revenues projected for what next year are probably going to be at a within like 20% of where we are now, give or take. So, if you were to price that in for just that, it could be in the mid 80s. But honestly, to me, I'm not sure it's done yet. There's still a lot of optimism with it. There's still a lot of people who are willing to buy it. So we could see it try to retake its highs up to 140 and see if it can failure. So you're looking for failure or you're looking for it to break out at this point.
Yeah.
So
Yeah, that's an interesting one. But I agree with you on that. I got nothing further to add. I think we all agree that it's overvalued and was being pushed by its growth prospects and the weird little like round robin structure they had going. And that's all sort
Yeah,
of that's come undone a little bit. But
one
next
one
one,
of
also going.
oh, one of the mysteries, because you said Netflix, I think by accident. Um,
Oh, did I? I meant NVIDIA, sorry, Netflix, yeah.
but
Netflix is
Netflix
coming up though.
has it. Oh, okay. Well, I
I'll,
won't. I won't.
I'll talk about talk about ARM. So ARM Holdings. When we spoke about this one, it was trading at 126 USD. We were discussing this because the lockup period was ending, and it ended on the 12th of March this year. And we all expected to see a dip, and it didn't really dip for a while. It held firm until about the middle of April, and then it went through a significant dip when SoftBank sold huge chunks of their holdings, and it eventually went down to $87 USD. And it's had a slow climb back up to a high of 186, but it's currently trading at 125. So that was a good play, but you had to have the foresight to, buy yourself enough time.
Yeah, you
Um,
had to be very patient on that one.
yeah,
Very patient.
it was a good play. And it did all right for me, but it's just I thought it would happen sooner than it did actually. Yeah.
Yeah, I think there could be some trouble coming up for chips in general, and um, I mean, we'll see what happens, but it, you know, I think we're closer to the end of the bubble we've been seeing than the beginning. Um, so I think that's good news for people who are angry about losing money on NVIDIA shorts.
Fair. Next one, Trump Media and Technology Group, DJT. So when we talked about this 6 months ago, it was at around $40. I can't find the exact price, around 39 or $40. It got to a peak of $65. And then it's had a very turbulent ride up and down, and it's currently trading at $17.10. So yeah, Trump obviously he had a lot going on, and this stock had a lot going on because he doesn't own it solely. Like he's got partners, and he was going through all sorts of criminal trials. He wanted to sell, I think, certain assets to pay down the debts that he owed, and his partners didn't want him selling out of this particular asset. So yeah, he had. I haven't really kept up with exactly what's going on with the stock. Obviously, I've seen Trump in the news, like the assassination attempt. There was a lot going on, man. So yeah, what do you think about
It,
this
it,
one?
I think DJT is just a play on Trump's, um, prowess, and it's also a social media play too. His return to Twitter, I don't think bodes well for DJT in and of itself, or X, I should say. But we'll see. I mean,
Yeah,
I think it's drawn down as far as it is going to in the short term, so
you
there
think
could be upside.
it's
It's more of
still
a
got
trade.
it's
Yeah.
at $17.10. It's still got a $3.6 billion market cap. So and it's not making money. This stock, man. I think let me just
It's
kind of find quickly. Can't find the. I'm trying to find the financials. One second. So the
good luck if
financials
you
for
can.
say that again.
Say good luck if you can.
Uh, so it's got so in the last quarter, it had $836 million in revenue, and it had what do we got here? Operating income of what the fuck? How much is that? Hang on. Sorry, I got that wrong. It had total revenue of $836,000. Sorry, and it had an operating income of negative $18.65 million. So they're losing a bit of money. Um, It is an improvement from the last quarter, though. Last quarter, they almost lost $100 million uh, at an operating level. So that's not very good. Um, yeah, okay. So I think there's a fair bit of meat on the bone with this one. If I were going to look at this one and think about a position, notwithstanding like the election and like Trump's as a personality, like if you're looking at this purely on the numbers with, this is a shortable stock. It is not good. It's not doing well financially. But there's people will buy this on sentiment until the election. So I wouldn't touch it until after then, probably.
I would probably never. honestly touch it, but I would say that you could argue that it just keeps on having it's sort of going down until it has a reason to have capitulation and ownership. So it's just dragging itself down over the last 6 months or so, 3 months or so.
Yeah, you're right.
Um, I would
But-
just be careful in general with it.
So
Any
yeah,
yeah, the you can see the pops that happen, and that's probably more from short covering than it is from actually people longing the stock.
some of it would have been sentiment after the assassination attempt, definitely. But
Yeah.
people like retail and stuff looking at it. Anyway,
Mm.
Netflix when we talked about it, trading at $600, almost exactly, has had some big tumultuous ups and downs. Went to a high of 701.35 USD, currently trading at 675. So this stock has, and if you think about this on a longer time scale, like through all that trouble they had where they were talking about account sharing and they had all their subscribers drop off because of the conflict in Europe. At its lows, I know this is unfair, the other stocks we discussed, but at its lows, Netflix was $186. I'm not saying all-time lows, like it's like in the last 5 years, maybe even lower than that, actually, like 175 or something. And now it's come back like with a vengeance. Like its all-time high was, can't find it, 690, I think.
Yep.
Anyway, yeah, it's an interesting one. What do you think about Netflix?
Mm. I think I think Netflix is really just I think a lot of these larger FANG stocks, because Netflix is a part of that. Um, I think really what's happened is they sold off because people were unsure about how they would do with raising rates, right? Because that was coming into 2022, and sort of how they were spending money and how they were planning to make money didn't seem to mesh with that. But they've adapted, and obviously they've done well, so they've recovered those premiums. Um, to me, I think Netflix is too expensive at 700.
Oh, bro,
Um,
I would not buy it here, but
yeah,
it's in a huge like testament to how strong it's been and how it's recovered, and the management has done a fantastic job. Like it's still trading at a market cap of 289.87 billion.
yeah,
They've done a really good job to recover, and I think they've like when it comes to there's still risks for them, right? Like they've got competitors in the market, they've got pirating, but they have been raising their prices, and people aren't happy with that. But in general, like them having the free tier with the ads, them having like
hmm
multiple options for account sharing and how you can share between households now. And it is the premium streaming service. Like when you use Netflix, there are no issues ever. Like it's not their fault anyway. Like, compared to some other ones like Disney or like Disney's improved, but like other ones, I don't know, Prime, like there's always issues with the streaming platform. Netflix, there's never any issues, man. So it's a
no,
great product.
it is it and out of the streaming services, it probably deserves this price. But like we talked about in the macro, we'll have to see where things go. To me, everything recovering their 21 highs
Yeah, they
is
are.
is interesting. Um,
I'm gonna move on because we're gonna run
yeah,
out of time here. I want to talk
yeah, we
about
are.
two more stocks, but let's come back to Netflix next episode because I think they're fascinating and I really like them. SoFi. So SoFi, when we talked about SoFi, it was trading at 768 and it has gone way down. It got as low as 632. Currently it's 708. So yeah, not a good performance. I think a lot of the things that were meant to drive this as a catalyst was like loan forgiveness in the US for students,
Mhm.
them taking on more home loans, but obviously that's a tough environment to get new entrants at the moment. And they had some credit card stuff, but it was minimal compared to the rest of their business. So I still think at the right price, this could be a good buy, and I think its long-term prospects are good. But it's like for me, I'm not enthusiastic about it like I was when it was trading. What did it get down to? It got down to like 4 or 5 at some point. Like that, I thought was a
Yeah,
good buy, but it's not there right now. What do you think?
I think I would need to retest those lows, and I think below there's better value. And it can definitely do that because we've been seeing a lot of people are starting to have insolvency pressures and issues. At least consumers are. So obviously their credit card exposure isn't that big, but we're starting to see that as a problem too. I would just treat it very speculatively. If you feel $7 is a good price, um, don't just YOLO your entire
I think
uh, amount this month into it.
this
Just
is a good one to sell puts on, and then if you get assigned,
yeah.
this is a good one to wheel. I think this is a good wheel.
I
So,
think if you want to play ownership on it, and you expect a downside, potential downside, but you're bullish still because you're just unsure. What you can do is you can sell puts and you can also sell in the money calls down to your put strike so you can layer them out. So
what would we do with the premium? Just buy more shares or something?
you would just keep the premium on the side. And if it does go down to your sell put price, which should be the same as your sell call price, and you can hedge that with a long call. And the reason you want to do it in the money is because you're only going to risk about $10, $15 with your against your premium. So if it does go down below that in your time scale, then you've kind of covered yourself a whole, dollar, $10, whatever the premium is going to be on that. And
Hmm.
so you kind of have hedged yourself against some downside there without much exposure.
Yeah, I hear
Um,
you. I think that's a good play. All right, moving on. One more. Sorry to
yep.
cut you off, brother, but like
No,
last
no, no.
play, the worst, save the worst for last. Arnie's call out of Playboy stock. I am still involved in this one, and it's done really poorly. It was trading at 82 cents when we spoke last. It got to a high of $1.15, and it's now trading at 57 cents. And this is off the back of news that they refinanced their debt at a lower rate, which sounds positive, but they're
Mm,
having to seek finance to basically keep the company afloat. They've burned through their cash. They burned about 18 million last year. In the last since sorry, quarter of a year over year. I mean, they've burned about $18 million in cash. They've got about $18 million in cash left. Some of that cash is tied up in covenants. They're still trying to transform their business to digital. Um, and they're sort of making good strides there. Like that is growing. So that's positive if they can stay afloat. But they're also all over the shop. Like management of this company is so poor, man. Like they literally shut down the print media business just before, I think during COVID actually. Got rid of like the Playboy magazine, got rid of like Playboy TV, which was like a big money earner for them. And now they're trying to bring back the print magazine. I don't know why, but they are. And it's like, I feel like they just can't make up their mind about like strategic direction. So I have no confidence in this one. I'm just going to hold. I might still add a little bit here and there, but it's just been really poorly managed and it's a huge destruction of wealth. So if anyone that followed me in on this, apologies, it's a bad one. But yeah, sometimes you have these bad ones. Give us 30 seconds on this, Wiz, and we'll wrap up.
okay.
Wiz, give us 30 seconds on
Oh,
Playboy.
oh. Um, yeah, it's just it's unfortunate how it's gone. And I think that the management issue has always sort of been out there as a potential problem. But I think a lot of the people who've been very vocal about it have often said that they want things to change and there's no response. So
Mm,
it's until things change in management, it may be good to
they
just
need
hold off
they
on.
need to fire the CEO. Anyway,
Yeah.
that's We Hate Money, episode 10. Long time between drinks, but thank you, brother. Take
Yep. Take
care,
care.
and we'll see you next week, hopefully. All right, cheers, mate.
See you, man. All right. Take care.